Hi, I'm Dishant Jain, Research Analyst at Edelweiss. When a person begins his investment journey, he comes across a significant chatter on something called multibaggers and how they can take his portfolio to the next level. So, what exactly are multibaggers? Stocks which give returns in multiples of what they actually costed are multibaggers. These are businesses which have strong fundamentals and are undervalued. Multibaggers generally have high corporate governance and have businesses that are scalable. Just like picking any other stock, multibaggers also require a lot of discipline, patience, and is individual to each investor's style. However, I can give you a few basic points which will help you spot a multibagger. The first step is to find an industry that can grow 4 to 5 times in the next 10 years. If the industry itself is not going to grow, it will be very difficult for the company to grow. Secondly, focus on a company which has a strong moat or a competitive advantage, such as high market share, lowest cost producer or unique resources, scale, a strong brand, an extensive R&D capability, strong technical tie-ups or intellectual property, wide distribution network, or favorable regulations. These competitive advantages will help the company capitalize on the industry growth and grow faster than the industry. Third, choose a company with a capable management. People often underestimate the importance of a capable management in a company. Choose a company which has a stable management with high integrity. Choose managements which have been able to successfully navigate cyclical and technological changes. It is always better to avoid companies where you see frequent business model changes. Fourth, focus on a company with a clean balance sheet. As a ballpark figure, choose companies where the debt to equity ratio is less than 30%. High debt would limit the innovation and aggression of the management and the company. Also, ensure that the company is able to consistently generate cash flows and an ROC of minimum 15%. Growth without ROC and cash flows will lead the company into a debt trap. Fifth, reasonable valuation. A good company may not necessarily be a good stock. When investors overpay, even a great company's good performance can be wiped out by valuation compression over time. Even if the stock is appropriately priced, it leaves very little room for errors and disappointments. Investors should focus on finding out the value of a company and then pay a lot less. When the price paid is a lot less, the chances of re-rating increases, which may lead to the stock becoming a multibagger. Lastly, the most important factor for finding multibaggers is patience. Most investors cannot resist the temptation to constantly buy and sell. However, great investors have succeeded because of inactivity. Investors may have found the best stock at the best price, but this urge to constantly act may lead them to missing multibaggers. If you cannot hold on to your winners over the long term, then the entire process of finding the best stock at the best prices is futile. As I mentioned earlier, there is no single sure shot way of finding a multibagger. However, if you keep these basic guidelines in check, you may end up making a smart pick. Thank you.